mean, as long as they have a semi-safe income stream, there's absolutely no problem for financing. It's really, really cheap. It's probably the cheapest after Japan. As soon as it becomes risky, because no one wants to make the same mistake they made in 2007, it quite suddenly drops off or becomes really expensive. But everything is kind of reasonably safe. You have absolutely no problem financing, quite the opposite.
On the back of that, the difficulty is that development, again, is, the lack of development is not only just driven, it's not by the lack of tenants, it's driven by the lack of a bank taking risk. Also, the land pricing at the moment is so high that you've now got to look 2-3 years in the future and calculate with an exit of 3.25%, which of course doesn't end highest levels of rent as well. But I think the financing, there's an issue, which again becomes a point where I think investors like ourselves then go in as a forward funding structure or a forward purchase structure, because that's our niche now. That's where we've become active, where the banks don't finance, where the developer needs an equity partner. And then if you believe in that rental market, you go in and go either fully speculative or partially speculative into these buildings. And that's where your yield differential is. And that's where we, again, make our biggest stake and success stories at the moment.
Philip's right. We're seeing the MES side of the equation just with our domestic insurance clients. Very interesting. That's not something outside Germany, but in Germany. And they're happy to pick up the yield, and they're happy to understand the real estate risk.
I mean, we finance in the residential sector at sort of 60 to 70% LTVs, normal debt, and also bonds. We see a lot of interest in debt bonds and sort of up to 75% LTV. You get very good terms at the moment, even from the German government through KfW loans.